So on next week's auction on August 12th by Bank of Uganda, where Bank of Uganda will be selling off the 20-year bond and the 10-year bond, a deeper analysis tells us what we should expect. Now, one, interest rates have been coming down. It's not abrupt. That was expected. You remember, we are pre-2024. You have to understand the cyclic nature of interest rates and how they work in treasury bonds. Before 2024, interest rates were 15%, 14.5%. That's why the 20-year bond, the current 20-year bond, the 2043, it premiered at 15% coupon rate and interest rate in July 2023, right? Come 2024, we start to see from 15 entering a little bit of 16%. And by the time we reached 2025, pre-election, there was premium, what we call political premium. There was anticipation that something might happen. And two, the government at that point is spending so much money because of the elections, because of the programs they have to implement. Every single time there is an election, interest rates will go up. They went up that to the extent that, remember one time we had, we thought we might even breach 18%. It was a pre-election fever, which did not happen. Now, coming 2026, we knew deliberately, and we had seen the reports by the Minister of Finance, the debt report, the projections. They had to find a way to bring back interest rates down. One of the other things that drove interest rates up at the time, you remember when Parliament, the 11th Parliament, passed the Anti-Homosexuality Act, which somehow, somewhere, it led for external financing to be cut off. World Bank and a few others. At the same time, China reduced the reliance of lending to African markets. So there were certain factors that literally came into play that government all of a sudden had to rely heavily on treasury bonds as their source of borrowing. Then it meant so that the 17% that we got in 2025 were the exceptions, not the norm. The 16.5 and above, if you are to invest in the treasury bonds and you are to invest in them long term, the 16.5, the 17%, if you entered treasury bonds in mid 2024 and 2025, the 17%, those are the exceptions. They are not the norms. The norms are 15 and 14 and 13%. So you have to first understand that. And two, then the question becomes, how come we have just moved from 17 to now 15%? It's not all of a sudden. Let's pay attention to the last auction we had on July 30th. The 20-year bond, the 25-year bond comes out at a 16% coupon yield to maturity. That's the yield to maturity we had on the 25-year bond when it premiered on August 2025, a year ago. Deliberate move to make sure interest rates come down. But they are also still high. We still make a lot of money in treasury bonds even when we feel like interest rates are low. So it's not, the 17% are not the exception. It's not like something has happened. It's not like the economy is doing better. It's not that, it's not like the economy is doing better. It's not that the inflation is lower. It's not like the government doesn't want to borrow. No, it is going to still borrow over 25 trillion in this financial year alone. In July, we had 3 auctions. It's just that the 17% might not come back anytime soon. At the time when 2 other factors have come to play. One, Bank of Uganda is doing its major play in making sure the monetary policy is progressive for the economy. They want to see more and more money being lent, especially by the financial services, to productive services. They are doing the absolute best to making sure they are, even individuals like us, don't so feel comfortable investing in treasury bonds, and we go invest in riskier productive ventures that develop the country a little bit more. 2, World Bank is back at play. When you have to appreciate the history, the last 2.5 years, 3 years, to understand what came in 2024, 2025. When World Bank is the cheapest lender. Of course, its lending is concessional in the way that you have to do certain things. They have to put there certain conditions that you have to first fulfill for them to lend you money at cheaper interest rates, 1.5%, 2%, 3%, and long term. So when we passed the Anti-Homosexuality Act, they suspended the new financing, which somehow, somewhere, it cut us off at the wrong time. When China, at the time when we were looking east, it cut us off. At the same time, the development, DGF, the Democratic Financing Facility, the Democratic Governance Facility had been suspended. That was 100 billion in financing to the economy per year. That was cut off. European Union was being cut off. There were cases which were at the European Union Parliament because of certain political measures. So our external cheaper financing was being cut off. So our reliance was major in Treasury bonds. Now European Union, we are getting back. The PSST has done a good job to try to bring back World Bank. They announced a $2 billion financing to the economy recently. The IMF African gentleman was in State House in Jan-Feb to try to come back with better financing and the terms and conditions that they needed to see. When you look at the report, our credit rating, sovereignty rating, has stabilized. You would have expected in 2025 it would have been worse, but it did not deteriorate. So it's getting better. The team at Bank of Uganda and Ministry of Finance have done an incredible job to make that. 3, there is financing expansion. They are trying to issue a Sukuk bond, which should come out in this August, hopefully. If the cabinet approves it, we shall get the details of that. African Development Bank is coming back. The oil revenue is creating an excitement in the economy. That's money we are expecting to come that should give us a boost. The Uganda Revenue Authority tax mobilization measures are getting better. That all those factors are at play, and it's giving the government, the Ministry of Finance, and the people at Bank of Uganda the impetus to push back on higher demands of higher interest rates. So when you look at the last auction, the 25-year bond, and you see the government rejecting over 900 billion, they are sending a signal that we shall borrow, but we are not going to borrow at any rate. And I believe the PSST, the Permanent Secretary to the Ministry of Finance, has said it in 1 or 2 interviews, where he said the government wants to do business with investors. The government wants to borrow, but they do not want to borrow at any rate and at any condition. So they are, as part of strengthening the economy, that is where you have to look at it. So the rejection of 900 billion, it doesn't mean that there weren't people asking for a higher cut-off yield or a higher interest rate on the 25-year bond. Potentially someone was asking for 17%, 17.5%. Now when they reject that, it does two things. The first one, it sends a signal that next time if you are to come back, please come back with better rate. Align with everyone, otherwise we're not going to allocate you. And remember, there is so much money out there. The 25-year bond, when it auctioned off on July 30th, it attracted 1.2 trillion, and they rejected 900 billion. Where do you think that money went? It's going to come back on August 12th. So the only difference here is that the market makers now, they're going to come back with an understanding that the government might not borrow at any cost. That rejection is like when you are, it's like when you send a first offer and someone rejects it, then they say, go back and improve your offer. To the government, improving the offer you have to give them is about you bringing better interest rate. And that is what is signaling the interest rate coming down. Anyone who has been in this market for the longest time, they know it always happens. It's cyclic, it's in nature. It is in no way an indication that, oh, wait a minute, foreign investors, institutional investors are moving away from Uganda. No. Had it been the case, had it been that the foreign investors are moving away from Uganda, actual interest rates would go up, because the foreign investors, especially the institutional investors, right now own over 10% of Uganda's treasury bonds. What that means is, if they are to move away from Uganda, they would be selling off treasury bonds, and to dump a 10% portfolio, it's too much. To dump a 10% portfolio into the economy, it will make interest rates go up, which is not happening. Interest rates are coming down. Interest rates coming down, it means it's strengthening the economy. It's good for the economy. The cost of borrowing, because interest rates move in tandem. Maybe in one of the soon to happen monetary policy committee statements, maybe even the central bank rate will come down from the 9% and above it has been at. They might bring it down. And if that happens, they are signaling interest rates across the board to come down, both for treasury bonds and both for borrowing, cost of borrowing across the different productive sectors. That's why you see, when we think about the auction that is going to happen in 2 weeks' time on August 12th for the 20-year bond, we know interest rates are not going to be high. The fact that the 25-year bond, which has a higher tenor period of 24 years to go, managed to just come out with a cutoff yield of 16%, it sends a signal that the 20-year bond then, it cannot breach a 16%. It can, but the chances of it breaching it are lower than it being below 16%. The fact that on almost a month ago, which is July 15th, the 20-year bond came out at a cutoff yield of 15.95%. It sends you the same signal that maybe, it sends the same signal that maybe the 20-year bond will not breach the 16%. The question is, where will it be? Right? If it comes out at 15.45%, where I expect it to be there, we shall just get a 1.2% discount. At least for as long as the premium, the cutoff yield is above 15.2, we shall get a discount. If it comes out at 15.45 or 15%, we shall just get a 1.2 to 1.3%. If it comes out at 15.65%, we shall just get a 2.4% discount. If it comes out at 15.75%, which is more realistic, we shall get a 3% discount. Yes, the 20-year bond, it will be 3% discount at 15.75%. If it somehow comes out at 15.95%, the same rate it got us on July 15th, we shall get a 4.1% discount. You can see, that means the 20-year bond for it will be within a discounted position. The question is, with what will it be? So my anticipation is the rate will be between 15% or 15.4% to maximum 16%. There is a small possibility that somehow, somewhere, they might breach the 16%. But given the history of what we have seen, the last 3 auctions and whatsoever, it might not happen. So do not expect that, especially what's happening in the secondary market. Now, that is the 20-year bond. The 15-year the 20-year bond, however, there is going to be also the 10-year bond. The 10-year bond, the one with the 2037. The challenge with that bond, I'm using the word challenge deliberately, is it has a coupon rate of 16%. The last time it was auctioned off, it came out at 15.45%. That was on July 15th. If the interest rates in the 20-year bond go down, also the 10-year bond will go down. It's how it works. It's how it works. So somehow, imagine if it brings out a 15.45%. Of course, anyone who buys the bond on August 12th will pay a 6% premium. But it can be lower. It can be 15.2%. Why? The 10-year bond will follow the 5-year bond. The 5-year bond recently, it came out at, when recently Bank of Uganda sold off the 10-year bond, which was on July 30th, it came out at, let me get you that rate. I don't want to, it has skipped my mind, right? Yeah, it is here. Let me get it that way I don't misquote it. The 5-year bond, yes, it came out at 14.25%. And the 15-year bond came out at 15.65%. For those of you who did math, who did extrapolation, you can see where we might be. Between 14.25% to 15.65%. So if it comes out, let's start 15%, the 10-year bond, then automatically you will pay 8.5% premium. If somehow it comes out at 15.4%, we shall pay a 6% premium. But it can breach and it comes out 15.6%. Then we shall pay 5.4% premium. So, as you make your investment decisions, at least appreciate and understand that interest rates are truly coming down. It's a deliberate, it's expected, it's going to continue happening until they will settle in within the 14-15% interest rate range, especially for the long-term bonds. That's where, especially between 13 to 15, that's where it doesn't break the economy, while at the same time it makes money for the investors.